Greetings viewers. I, Dr. Isha Raval, Associate Professor at Vivekananda Institute of Professional Studies, Technical Campus, Delhi, welcome you to the series on security analysis and investment management. Today, we will be focusing on valuation of securities. That means, what should ideally be the price of a particular stock and how do we measure it, how do we identify that the stocks are undervalued or overvalued, or are they at their intrinsic value. Why is it important? Because when we start investing our funds in the stock market and when we look at the market prices of various stocks, it is actually very confusing. Because how can we identify that a particular stock which is trading at a price of say 101.02 is actually the right buy for us? So as an investor, we need to understand that whether this stock is undervalued and I should buy for it, or whether the stock is overvalued and I should avoid that stock. So the whole idea is that we always, as an investor, we always look for opportunities where we can make quick money, or where we can identify all those stocks which are currently trading in the market at a price which is less than their intrinsic value. And what do you infer from the word intrinsic value? That means the true worth of an asset. What ought to be the price? What ideally should be the price of a particular stock? So most of the investors, they look at price movements in securities markets and they actually perceive the opportunities of capital gains in such movements. So all would wish if they could successfully predict them and ensure their gains. However, it's only a few who are there, they recognize that value determines price and both changes randomly. So the value also changes and the price also changes. It would be really useful for an intelligent investor to be aware of this entire process, that how the prices are moving, how is the valuation done. So that is the whole concept behind valuation of securities. So when you invest, there are basically three rules which you follow. The first rule of an investment is that you must buy when the value is more than the price. That means the calculation which you are doing is much more than the current market price of the particular stock. This underlines the fact that shares are underpriced and it would be a bargain to buy now and sell when the prices move up towards the value. Rule number 2, sell those stocks, sell those shares when the value is less than the price. In a situation like this, shares would be overpriced and it would be advantageous to sell them now and avoid less when price later moves down to the level of their value. So it is better that you, in case you possess such shares, you must sell them off, because the value calculation which you have done is certainly less than the current market price. We have seen this in a number of cases whenever there is an IPO. So of late there was an IPO of LIC and there was a lot of hype in the market. Everybody wanted to apply for this IPO and get at least some sort of allotment of shares. But when that IPO got listed on the exchange, it actually turned out a very sorry figure for all the investors. So we need to do our calculations right, and vice versa. There are a lot of shares which do not perform well during their IPO, but when they get listed, they really trade at very high prices. So as an investor, it makes sense to sell all those shares which are overvalued, or at least avoid them till the time they do not turn up to their true worth. Now that was rule number 2. So rule number 1 was that you buy when you find an undervalued stock and you sell when you are actually in possession of an overpriced stock. What is rule number 3? Rule number 3 says that do not trade when the value is equal to the price. Now why should you not trade? Because this is a state when the market price is in equilibrium and is not expected to change. So when there is no expectation of a price change in the future, why as an investor would you prefer investing in such a stock? Because you know that the future, the price remains the same. So if you're putting your funds in some particular stock today, you expect that stock to appreciate in future. But when you foresee that the price is already in equilibrium, it makes no sense for you to put your funds in that stock. So these are the basic investment rules which every investor should technically follow. But because there is a lot of irrational exuberance in the market and people do not do their valuations, their calculations right, and they make mistakes. So there are various models which are used for valuation. The first model which we are discussing is the basic valuation model. This model actually values an asset and says that the value of an asset is equal to the present value of its expected returns. That means if you are investing in stock A, what are the expected returns from this particular stock, say 1 year down the line, 2 years down the line, 3 years down the line, and then you try to find out the present value of all these expected returns. So what is the current worth of the returns which I am likely to get 3 years from now? Now this is true particularly when you expect that the asset you own provides a stream of returns during the period of time. So if you have a holding period of 3 years, you expect certain return at the end of year 1, at the end of year 2, and then at the end of year 3. You as an investor would like to know that what is its worth today? How much am I going to get 3 years from now, and what is the present value, what is the current value of all the expected returns? Now to estimate this expected or estimated stream of return to value a security, you need to discount the stream of cash flows at your required rate of return. So if you're bearing, say your expectation is say 15%, you will discount all the future cash flows with this 15%. Now this process of estimation of value requires certain values. The first is the estimated stream of expected cash flows. That means you have to be very clear as to what you're going to get after year 1, after year 2, and then after year 3. So if your holding period is 3 years, you need to know what are your expectations from the next 3 years. That is requirement number 1 to do the calculation as per the basic valuation model. The second requirement, as we discussed, is the required rate of return on the investment. The required rate of return, it varies from security to security because the kind of risk you are bearing in security A is not the same in security B. That is why the required rate of return varies. So, how can you calculate this entire value? As you can see here on the screen, given a risk-adjusted discount rate and the future expected earnings flow of a security in the form of interest, it can be in the form of dividends, it can be in the form of a cash flow. So when you know that you have all the values with you. So for suppose we have 3 years investment horizon. So we have CF1, we have CF2 and CF3. The cash flow which we are expecting at the end of year 1, at the end of year 2 and at the end of year 3. As per the basic valuation model, we need to discount it. So something which you are going to receive after year 1, we need to do the discounting for 1 year. And the discounting will be done with the help of your risk adjusted discount rate, which is generally known as the interest rate. So we can calculate the present value of our entire share by discounting cash flow 1 with 1 plus R, your required rate of return. Then we add it with the cash flow 2, and cash flow 2 again we need to calculate its present value. So we need to discount cash flow 2 with 1 plus R raised to the power 2 because here the waiting period is 2 years and so on and so forth. So when you do a summation of all these the present values of all the cash flows, what you land up with is your present value of that particular security. So if you land up with a value of say 120 and the current market price is say 100. So the value which you have done is valuation is 120 and you're getting that stock in the market currently at 100. So it makes sense for an investor to invest in that particular share. Now this model has been criticized a lot because it actually has a lot of practical challenges. For instance, it may be quite difficult to assume that every investor in the market exactly measures the value of cash flows and risk adjusted required rate of return. Why? Because you don't know that whether you will be getting 10 rupees as the dividend after 1 year or whether you will be getting 15 rupees as the dividend. So my prediction can be different from yours. So prediction of A can be different from prediction of P. Secondly, the required rate of return with which you are doing the discounting of your cash flows will vary from individual to individual, and it will also vary from one security to the other. Further, the investor's expectations on compensation for risk may also be different because it varies from investor A to investor B. So, just a small change in these measures will actually cause a lot of change in the predicted value of that particular security. Therefore, it is not really possible to generate a single value based on this particular formula. The another challenge, practical challenge, is that the return, the risk, and the value, they would tend to change over time. They will not change, they will not stay the same. Because today, if I'm making a calculation, tomorrow the same calculation will get a different result. Therefore, security prices also, they may rise or they fall with buying and selling pressures happening simultaneously. Because the securities are being, the supply is same. But at the same time, the capital gains get affected and the return expectations also vary. So consequently, estimates of future income, they will have to be revised and the values have to be reworked every single day. That is why this model is actually seeking a lot of criticism. Similarly, the risk complexion of the security, it may change over time. A security, for example, these days we are hearing a lot about Adani Group. So Adani is one such stock which was termed extremely risky few days ago, but now with time, passage of time, things have stabilized. So the risk aspect associated with a particular stock varies from time to time. The firm may overborrow or they may engage in a risky venture. So an increase in risk would raise the discount rate and lower the value of a particular security. Every new information, anything new which comes to the market will certainly affect the value of the security, and the buying and the selling pressures will also vary, which keeps a change, which keeps getting or bringing in a lot of changes in the prices on a continuous basis, and that is why this valuation is not really constant. So then this was the first model which we just talked about. There are various other models like balance sheet valuation, dividend discount models, and the one of the very famous approaches, the earnings multiplier approach. So let us move to the second method, which is the balance sheet valuation. The name itself is suggesting that you are doing your valuation on the numbers which are given in the balance sheet. Under balance sheet valuation, there are two methods which an investor can use. The first one is book value method and the second method is liquidation method or liquidation value method. The book value method. Here we try to calculate the price of a security or the value of a security or the intrinsic value of a security on the basis of book value. So we try to calculate what is the book value per share and then we compare it with the market price. So the formula to calculate book value is that you try to get the net worth of the company, which is in the numerator, and we divide it with the number of outstanding equity shares in the market. The net worth of the company is nothing but the paid up equity capital plus any reserves and surpluses which the company has preserved for itself. So we try to calculate what is the value of a particular share as per the entries in the book. What is the net worth of the company, how much equity capital it has and how much profit and the reserves and surplus it has. So we do a summation of it and we just divide it by the number of equity shares and we try to get the book value. So the rule says that if the book value is higher than the current market price, it's a valuable bet, you must buy. But if the book value is less than the price, the current market price, you try to avoid that share or in case you have it, you sell it off. But if we let us do a calculation, let us understand it with the help of an example. Suppose there is a company by the name of ABC Limited and the net worth of this company is rupees 36 lakhs, while the number of outstanding and equity shares is say 2 lakhs. Now we do a calculation and we find out that the book value is equal to the net worth, which is 36 divided by 2, the total number of equity shares, which brings us to a value of 18 rupees per share. Now if in the market, the current market price you find for ABC Limited is 20, as an investor, As per your calculation, ideally the price should be 18. The worth is only 18 as per the book value method, but you are getting this share at a price of rupees 20 in the market. So certainly it's a case of avoidance. We should not buy this stock, and in case we hold it, we must sell it off because the future is bleak. Now, this method of doing calculation has been criticized a lot, because the book value method is completely based on accounting conventions and policies. It is not real cash flow, it is not real profit. It is just based on the accounting convention and policies, whereas it is also subject to a lot of subjectivity, because there is a lot of arbitrariness in this method, and we really cannot say that in a concrete way that yes, the true worth of this stock is 18 just because we have calculated it with the net worth of the company. So this method is really not much used and is not preferred by the investors because of the presence of lot of arbitrariness. The second method based on balance sheet valuation is liquidation value method. Now liquidation means we actually assume that the company is going into liquidation, the company is trying to wind up its business, and whatever value it realizes by selling all the assets of it, minus the amount which needs to be paid to the creditors or the preference shareholders or any sort of creditors it has, be it anybody, any loan or something. So whatever value you realize by selling all the assets and the amount which you have to pay to your creditors, the difference between the two is actually the liquidation value of that particular company. So technically, we are trying to say that what if the company goes into liquidation in times to come? What if the company decides that we want to wind up the business? So what is the money what is the realizable value of this company? So we sell off all the assets in one hand, so this is the return, and then we try to pay off all the debts. The difference between the two becomes the liquidation value of that particular company. And then whatever value we get, we divide it with the number of equity shares. As an investor, you would never want a company to go into liquidation, and especially a company in which you are putting your funds, because a company needs to be an ongoing entity. A company should never go into liquidation. It should never wind up its business. So that is why this method is not used much by many people. The second problem with this method is that you really cannot predict what is the value which you are going to realize by selling all the assets, because it is subject to a lot of, I would say, there's no objectivity here. An asset, you may say that a building can be sold off for a particular price, however the second person may vary with your opinion. So it is really difficult to do the calculation that how much are we going to get by liquidating all the assets of the firm, and if we just rely on the book value of those assets, that is not a practical assumption. So here again, when we are trying to calculate the liquidation value, we really say that this method is, number one, really difficult to apply because of the calculation of realization value. The second is that when we are saying that the liquidation value method should be used, it is actually not taking into consideration the earning capacity of the company. The company buys the assets to do business. The company, purchases land, building, machinery, invests in human resource, and goes in for patents, creates its goodwill. Not because it has to sell off all these things, but it is buying or making these purchases or doing such investments because the company really wants to make it big. The company has to earn from these assets. By using these assets, the company intends to make a good earning. Now, that is why this method is not reflecting the true earning capacity of a company. And when the true earning capacity of the company is not being taken into consideration in this method, it is difficult for an investor to calculate how much earning or what can be the expected return from this particular stock or this particular company. That is why this specific method has also come into a lot of criticism. So as an investor, we generally do not use book value methods or liquidation value method based on the balance sheet valuation of the company. The next method is the PE approach to equity valuation. The PE word means market price to earning ratio. PE ratio, price to earning ratio. How do we calculate the market PE ratio is that we first see what is the current market price of a particular stock, and we divide it with the earnings per share of that particular company. So when you calculate the PE ratio, you actually get a fair good idea as to how a particular company is performing in terms of, suppose there is a company or a stock with a PE ratio of 10. The interpretation is that 10 is in the numerator, that's the market price, and if it is 10 is to 1 or 10 divided by 1, the earning per share is 1. So the interpretation is that for every 1 rupee earned by the company, the market is ready to pay 10 rupees for it. So a company with a PE ratio 10 depicts that for every 1 rupee earned by the company on every share, the market is ready to pay 10 rupees for it. The market is ready to spend 10 rupees. Similarly, if there is a PE ratio of say 50, so every 1 rupee earned by the company, the market is ready to pay 50. That is how you kind of interpret the PE ratio of a particular stock. So suppose there are two stocks, stock A and stock B. The PE ratio of A is 5 and for B is 10. As an investor, there is a strong myth that we must buy a stock with a low PE ratio because that is a cheap bet, that is a better bet for us because we are paying just 5 rupees instead of paying 10 rupees for 1 rupee earned by the company. However, it is a myth because a company which is actually able to get a PE of 10, that means it has the potential and the market can really see the potential in that company and they can predict the future growth of the company, and that is why the market is ready to spend 10 rupees and not on stock B and not even just 5 on stock A. So this approach, the PE approach to equity valuation, it is fairly simple and it is widely followed in the stock market. Whenever you see any stock, you will be easily able to get the PE ratio of that particular stock. The first step under this model is you need to estimate the future earnings per share. So when we are talking of the denominator, the earning per share, we are actually referring to the future earnings per share. That is number one. Next, the normal PE ratio we need to find out. We need to find that what is the normal average PE ratio for this particular company. So product of these two estimates will give the expected price. That means, first of all, we are calculating the expected EPS and then we multiply it with the average PE ratio of this company. So what are we left with is EPS multiplied by market price upon EPS. We are left with the market price. The most practical way of using PE model is we first compute the industry average PE or the PE of a similar firm, and then we multiply the same with the expected or actual earning of the stock. That gives us a fairly good idea as to what ideally should be the PE of a particular company. So PE of an industry, it is expected to be high when the industry is in high growth industry. It is actually rising, it is growing like by leaps and bounds. Whereas the PE ratio of a particular company, it will be low if the industry or the firm is expected to show a low growth rate. So as I just discussed that there is a myth that a company with low PE ratio should be preferred over a company with a high PE ratio. It is actually a myth because as an investor, we would like to invest in a company which is likely to grow in the future. It is actually PE is also affected by the risk associated with the earnings. So if the earnings are not so regular of a particular company, it is difficult to calculate its PE ratio. As an investor, you prefer investing in those companies where the growth rate is pretty high, where the sales are rising, where the profit is rising, the revenue is rising. And as an investor, you can safely, first of all, identify what is the PE ratio of the entire industry in which the company is operating, which is readily available on most of the stock indices as well, in stock exchange websites. And you can identify that if a particular stock belongs to, say for example, steel industry, and you're trying to do the valuation for Tata Steel, so you see that what is the PE for this particular industry or any major leader apart from Tata Steel in the steel industry. You get the average of it, you try finding out, and then you make the prediction of the future expected EPS of Tata Steel. So when you multiply this expected EPS with the PE ratio, what you are left with is the market price or the ideal value which you must place, the value of a particular stock of Tata Steel Industries. So here there are a lot of Indian companies, as you can see, wherein their sales growth rate, their the future growth rate, the sales and the profit growth rates are given, as well as the PE ratios are given. So these are the leaders. This data is from the year till 2001. So if you look at all these companies and try to relate that what is the growth rate in sales, what is the growth rate in profits, and what is their PE ratio, you can easily identify that the PE ratio is highest in case 1 and for Z technologies, and it is the lowest in the last company. In fact, the PE ratio is coming out to be negative. Now, if we follow the method, or if we follow the approach that the lower the PE, the better it is, technically you will try to get a company wherein you are getting negative PE. So negative PE is actually a wrong calculation. It actually can never happen, because when we try to interpret what PE stands for is that you are saying how much are you ready to pay for 1 rupee earned by the company. So if the PE ratio is say 50 in the first case, the company, the investors, the market is ready to pay 50 rupees for 1 rupee earned by the company. But if you look at the lowest in the last row, the PE is negative. So that does not mean that the market, instead of the market, the company will pay them for every loss which they are making. So we can say that negative PE actually cannot be used. It should ideally, it cannot happen, because why will the market pay you for the earnings made by the company or for the losses made by the company? So technically, when we want to do a comparison, we will always see the trend is such that all those companies which have high growth rate, whether it in terms of their sales, or it is in the terms of their profit, or it is in terms of their order book, they are reflecting, they are growing. The probability is very, very high that their PE ratio will be high. But the companies which are laggards, which are not performing up to the mark, or their sales are not growing really well, in that case, the PE ratio of such companies is usually on the lower side. So this is one method which is really very practical, because as an investor, we really, one thing which we are focused on is the cash flow, as we discussed in the first model, that how much are we going to earn, dividends, how we are going to get, the profit we are going to get in the long run, and then we try to find out its present value. But on the book value method, as we used the balance sheet method, where we were talking about book value and the liquidation value, we are not talking of the future. We are just talking of what is there in the books as on date, and we are in fact talking about its liquidation. But this PE approach of doing valuation is really appreciable, because here we are doing the calculation on the basis of what we are expecting in the future, what is the growth rate, how are the profits likely to be increased, to be multiplied. Therefore, this is one such approach which is readily used by most of the investors for doing calculations. That is all for today. Thank you so much. Happy learning.